Hi everyone, welcome back to my channel. Today we're going to cover S corporation taxes. This was one of the questions a subscriber of mine asked, and so I thought I would upload a quick video with an answer. By the way, if you haven't already, please go ahead and subscribe to my channels both on YouTube and on Rumble. All of my links are in the description below, and don't forget to ring the bell to turn on video notifications. So an S corporation is a hybrid business structure that has characteristics of both a corporation and a partnership. Technically, it operates as a corporation, but unlike a true C corporation, it is not subject to double taxation, since it is the shareholders and not the corporation itself who pay federal income taxes on their business profits. This is why you sometimes hear people say this is a flow-through or a pass-through business entity. Even though its taxes flow through to its owners, an S corporation must still file an annual corporate tax return. This is more for documentation purposes. It does not mean that the Internal Revenue Service will tax you twice on the same profit. The name itself, S corporation, might be misleading because most corporations are double taxed. This means that the business is responsible for paying income tax on its earnings, and then the shareholders pay a second tax when they receive their dividends or distributions from that same corporation. But an S corporation is different in that regard because it, as a separate legal business entity, does not pay any taxes to the IRS. Its income and deductions are passed through to each shareholder or owner to be reported on their respective personal income tax returns in proportion to their respective shares of ownership. An S corporation does not pay income tax, but the IRS still requires it to file an annual tax return on Form 1120-S. This tax form is for informational purposes only. It shows a summary of the business earnings and business expenses. Now, in addition to the Form 1120-S, the S corporation is also responsible for preparing a separate Form K-1. It's prepared for each shareholder to report their share of earnings and deductions on their own tax returns. So at the end of a year, every owner of an S corporation will have a copy of their K-1 report. When you, as an S corporation owner, are ready to file your personal taxes, you will need to incorporate the amounts reported on your K-1 report into your own income tax return. For example, when you receive the K-1 with, let's just say, $90,000 in income and $60,000 in deductions, your personal income tax return will include an additional $30,000, right? So the difference between the two amounts of taxable income from the business that you own. Since you include these amounts on your own tax return, you must follow the appropriate deadlines for your Form 1040 personal income tax return, which is typically April the 15th. So I hope this quick video helped clarify how an S corporation is taxed. Thank you very much for watching. Of course, there are many more details and nuances that we can talk about in the future. As I've already shared with you, I plan on uploading a series of videos on S corporations. Hopefully that is something that can help you. If you want to see more content like this, you know what to do. Let me know by liking this video, subscribe to my channel on Rumble and YouTube, and make sure that you click the bell notification to stay up to date on the latest content. And I will see you in my new one soon. Bye for now.